Hey guys, welcome back. This is episode 15 or part 15 of the series on Python, value investing, stock analysis, all that good stuff. All right, so now we're going to talk about, in the previous episode, I talked about like percent change, why that's kind of important. And also comparison. So let me kind of show you. So earnings growth of Google, right? So okay. So actually, the cash balance. Actually, I don't know the exact charting. But let me talk about like why percent change matters, right? So when a company is growing, it's hopefully making more money and getting more market share, and it's reducing costs, and things should sort of compound, right? So that's how you get this compounding effect, which makes a stock price sort of compound. So the way you can tell if it's compounding by looking at percent change, right? So a good example is like, so suppose like you have stock that's like 1, 2, 3, 4, 5. This is their earnings, right? 1, 2, 3, 4, 5, 6. If you look at the percent change, right? 1 to 2, that is, so if you do, so going from 1 to 2, maybe this is better. 1 to 2 is 100%. But if you go from 2 to 3, it's only 50%, right? Increase. So 3 to 4 is only 33%. So you get the idea, right? If you have a linear number, like 1, 2, 3, 4, 1, 2, going to 1, 2, 3, 4. It's, you're going up, so it's good. But your percentage is not going up, which means that if your number is going up linearly, that means your company is going slowly, right? That means your growth is slowing down. So you don't want that. So ideally, you want your growth to be like going up, right? So like let's say 1 to 2, 2 to like 6, and like 6 to, I don't know, like 12 or something. I don't know, some ridiculous number. So this is 100%. This is like 200% increase. 6 to 15 is like 250% or something like that, right? So ideally, you should be going up. So remember the past couple episodes I talked about charts and trends and stuff? Yes, that's okay, but you should always look at percent change as well too, because if the company is doing better, your percent change as well should be going up as well. This is not just about income, but this is about free cash flow, what you own, right? Like assets, like equity, and also your debt should sort of go down as well too, right? And sort of like not exponential, but at least linearly, like your percentage change. It doesn't have to be like this, but at least like within the relative like ballpark figure, right? It should be like, I'm not saying this is that, but I'm saying if you do 100% change now, hopefully next year it'll be 100% too, right? If not, that means you're probably slowing down in terms of getting rid of debt or acquiring assets or making money, stuff like that. So so let me give you an example, right? So let me I have so many things open. I'm sorry about that, people. All right, so remember net income for Microsoft income? It was like this, right? It was that. So just looking at that, and then if you just plot this, yeah, it's going up, right? It's good, but I don't know. Look at this. You see here, this chart here is like the slope is like really steep, right? But the middle part is like flatter, and then it starts going up again. So unfortunately, Yahoo Finance, Y Finance, they only give you 2 years of data, right? Like 4 years, so it's kind of crappy. But go back to the episode like 2 or 3, and I talk about how you can get data from this other vendor. It's free and you can download and do stuff. But you want this to be, you want the net income to go up, but you want the rate of change to go up as well too. So the way you can get that, okay? Remember, whoops, why is this? Sorry about that. Because markdown. Okay. So remember this Microsoft the net income is in reverse order. Okay. So the way you can reverse this. Wait, is this correct? Yeah. Okay. For some reason, Plotly knows that you should put the left date on the left side and the right date on the left side. Oh, that's pretty cool. Plotly is cool. Anyway. Remember, this isn't the reverse order. The old stuff, the old date has to be on top, and the new date has to be on the bottom. But for some reason, I don't know why it's that. The way you can reverse it. Okay, let's just actually, you know what? Let's not reverse it. Let me just show you this thing called percent change. Okay, so if you look at this, it's telling me that Microsoft is losing money every year, or it's going down every year, and that's probably wrong. That's because your data is dirty, right? As I mentioned, the time series, the order is completely in reverse. So the way you can get rid of that, or at least reverse it, is by the following syntax. It's the same as this, but you add bracket, colon, -1. And boom, it came in the right format. Okay, so now let's take a look at the percent change of that. Okay, now it's positive numbers. That's good. But what does this mean? Well, we're going to plot it. We just do dot plot. Okay, so now if you do that, now it's this. We're like, whoa, what's this funny thing here? Is it going to go down? No, that's because you into 2021, because it's doing percent change, so it's calculating the percent change from the previous, right? But 2021, wait, is this correct? Oh yeah, sorry. 2021, there's no date, right? So the first row had no date. Let me show you what I mean. Let me see, like 2008. Sorry, not 2021. 2018 had no data. Okay. So the way you can get around that is by doing dot drop NA, and it gets rid of the first one. Okay, and then you can do dot plot, and boom. So you can kind of ignore the first one, but you can see like 2020, it kind of slowed down and then it started picking up back again. It's unfortunate that we only have 4 years, but if you looked at this like over the past, like, I don't know, let's say 10 years, the chart will be more significant. It will. You can see a clear trend, but this one you can't really tell if it's going up, left, right, or anything like that. Okay, now let's talk about comparisons. Okay. Now, how do you compare all this stuff to other companies? So, suppose I want to compare these companies. So, suppose they're same in the same. They're competitors. They're not, but I'm just gonna assume. Okay, so let's say Microsoft, Apple, Google. I don't know what's the Facebook, right? They don't. I mean, Apple and Google and Facebook, they compete with each other. Pretty head on. Microsoft, Apple, they kind of compete, but I don't want to get into nitty gritty, but you get the idea, right? I just want to compare these companies. Dude, you can actually get a whole bunch. You can get these tickers in one shot by calling. Let's say like the comparison equals yf dot ticker and do tickers, and okay. Boom. Okay. So if you print that out, it's just an object, right? And the way you can get, for example, the quick ratios is like for t in tickers. I'm going to print. I'm gonna say I want to print the quick ratios. I don't know why. I'm gonna do format t, comma comparison. I'm just gonna copy it because it's kind of long. Comparison dot tickers dot t, right? We're going through each and every ticker, and then just print the quick ratio. So if you just print this, it's getting the data. Microsoft is that. Apple, Google, Facebook. All right. So remember what the definition of where is it? Yeah. So definition of quick ratio. Quick ratio definition is there's inventory, right? Remember, there's inventory. So obviously, if your numerator so if the inventory is high, your numerator is going to be low, which makes the quick ratio low. So if you go over here, Apple is low because, well, Apple has tons of hardware, right? They sell phones, predominantly phones. And Apple, Google, Facebook, they don't, they have hardware, but like who buys their stuff, right? Not a whole lot. And Microsoft, they don't really have it either. So anyway, so you get the idea, right? So this is how you can compare stocks by using the YF tickers with a list. So they can kind of go crazy. You can do all. Remember I was telling you about the free cash flow. You can compare them and see how to do it. Debt to equity. You can calculate the debt to equity and compare them, and then you can just do simple math formula like if like debt to equity of I don't know to equity, let's say debt to equity of writing pseudocode now, okay, of like cash flow of Facebook is greater than like D to E of I don't know Google or something, and then do something, right? Like I'm writing pseudocode. This is not actual code, but you get the idea, right? It's simple. So I think that's pretty much it. Oh, one caveat before I head off this episode is that there are things that you should always be aware in investing, right? I mean, it's not just Python. Like you have to have quality. This is quantitative. We're doing quantitative, but qualitative. So one anecdote I want to leave off is that just because your company, right, like Google, right, like let's say Google cash pile or something, cash pile trend. They have, yeah. So here, this is Google's cash pile, right? So Google is making a lot of money, right? It's a big company, and the graph looks pretty good. Question: is this good or bad? You have to think about that for a second. Is this good or bad, or is it better to have a chart that looks like this? This is actually revenue, but their cash looks kind of like this too. Which is better, like this or like this? So now you have to think about that for a second, because you wonder, like, why does Amazon always have no profit, right? And how come Google's always just piling up cash? Well, that's because you have to think about that for a second. Like, you might have to pause the video. Okay, so I'll just tell you. If you have a good reason to invest in something that is, well, that's a good chance of returns, you're going to invest in it, right? If you are like a company, like I don't know, like if you have a company where you know that you have a high rate of failure, like oil for example, you're not gonna take that much chance, right? So you're gonna try to hoard cash. Like Amazon, like Google still gets like 99% of its revenue from advertising, right? I mean, they have phone and this and that, but they're all means to an end, which is to serve advertising, right? Like their car, self-driving car, like Waymo thing or something. I mean, I haven't seen it yet. Maybe I don't know. Maybe it's just not my neighborhood. I haven't seen it, but Amazon, these guys are like aggressive, right? Like Amazon, they were the first one to like provide, one of the first companies to do public infrastructure, cloud computing stuff, right? AWS, and they do like drone delivery and all kinds of like robotics in warehouses and stuff. These guys take a lot of risk, right? So they use the cash to invest, so which means their cash is not going to be like straight up like this, right? Where is it? Yeah. So there's a guy named Peter Thiel. He's like one of the guys who started PayPal. He criticizes Google about this because he's like, yo man, you make all this money, why don't you invest? Do some innovative stuff. But like Google shareholders, like, I don't care. It's my stock. It's my stock. If it goes up, I don't care what they do, right? But Amazon, he's like, Jeff Bezos is a pretty forward-thinking guy, right? I mean, you could say he's evil and stuff. I mean, he's like, you don't pay tax and stuff, but he's a pretty innovative guy, right? Like he does this space thing. He invests into a bunch of e-commerce stuff, like a whole bunch of small mom pop franchisee delivery companies came out of Amazon, right? Because of Amazon, like third of the sellers on Amazon are like overseas, sellers. I mean, you could say that's good or bad, but that's not the point, right? The point is he's using cash to develop innovative stuff, right? And as a result, like Amazon stock is like crazy, right? Amazon stock is like what? I don't know, like it just. I mean, Google stock is good too. I'm not saying it's good, but they're. I think Amazon's bigger now, right? So if you look at their stock, look at their stock, right? Right, they're 1.8 trillion. How much? What is Google? Right, that's. Okay, now Google's bigger. But at one point, Amazon was bigger, right? So the point is, you want looking at cash growth, or any like charts and graphs doesn't really tell a story. Like if you do this quantitative stuff and you like the company, you have to look at qualitative, right? Like earnings per share doesn't mean anything for a growing company. Like I'll give you a good example, right? Earnings per share. Okay, I don't want to beat on Vail, but they're kind of like good company to sort of like, kick them while they're down, sort of. So this company, right, their PE ratio is 3.6. Okay, their EPS is positive, right, which is good. Their dividend is 20%. Now, do you want to own this stock? I don't know. Look at this chart. Do you want to own this? I don't know. Look at the financials. The financials probably, yeah, look, their revenue is going up, okay, but the net income is negative. I mean, the reason why I'm telling you is because looking at the quantitative alone, you're gonna have these sort of prejudgmental bias. You're gonna say like, if this meets my ratio, it's good. If it doesn't, it's not a good stock, right? So humans have this judgment error on investing because they just think only in terms of numbers. Especially like people like you and me, we're more data-driven type people. You're coding, I'm coding. You can't just look at that. Life is not about just numbers, right? There's qualitative. Like there's like, entrepreneurs have this thing called grit, right? Like you're down and things are against you, stacked against you, but you come out a winner, right? There's a whole bunch of stories like that. Like Nike, I recommend you read Nike story, Sam Walton's story. It's not just about numbers. There's a guy behind the story, like, he got his first store he opened and basically got stolen from him by his landlord, right? I mean, so if you look at the balance sheet, he went to zero, right? So you're like, oh, Sam Walton, his Walmart stock is gonna be nothing. Yeah, but except this is he's running the top two. I don't know if it's the biggest, but anyway, at least the top two retailers in the world. Well, I don't know, in US anyway. So you can't just look at that. You have to look at the qualitative as well. So anyway, I think I'm gonna put an end to this video. If you like this video, make sure to thumb up, like, and if you have comments, make sure you leave it in the comment section, because I'm going to pause this Python value investing stock analysis stuff because I have a feeling I'm going in the wrong direction, or maybe not necessarily the direction that people want to see. So I'm gonna start talking more in generalities. I will show code, like probably less. But I will stick to investing. I will stick to talk about investing. I will start talking more about like options and DeFi, which is decentralized finance. I know cryptocurrency is like a big thing now. Cryptocurrency is like a whole new sort of field in itself, right? It's like it's interesting because before DeFi, before decentralized finance came out, it was just pretty much gambling, right? It's just buy low, sell high. That was the only thing you could do. But anyway, I'll get more into it, and I'll see you in the next video. Thanks.